Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Don't turn it on and off. Just leave it how it is.
Okay. Yeah.
Just leave it. Don't turn it on and off.
Okay. Yeah.
When you turn it off, it's just the radio.
Okay. Yeah. So that's where the noise starts to. Because when I just started.
Okay, and I'll see what I can do.
Okay, yeah, all good. Yeah. All right, good morning, everyone. So today we're going to talk about exotic options. Same as last lecture, we're going to do some practice question towards the end of this lecture. So basically, I just picked some questions from your past exam papers, and we're going to work through those past papers together. All right, so today's topic is exotic option. And so all of the option we have covered in this course is so-called plain vanilla option. So plain vanilla option really means that it's very basic call and put options with some highly standardized features and trade on both exchanges and over-the-counter market. So that's called plain vanilla options. So plain vanilla options are normally written on individual stocks, stock indices, and foreign currencies. So basically, we covered all of those different underlying assets. So today, we are going to look at some different type of options where their characteristics is very different from plain vanilla options. So for example, they might be neither European option nor American options. So basically, they can be a hybrid of both. Okay, and we're going to look at the payoff of those different type of hybrid options. And also, exotic option give you other functionalities. So we're going to look at some of them and figure out their payoffs. All right, so the first exotic option is called packages. All right, so basically, packages provides a way to combine different stuff together in a portfolio. So basically, the packages function just like a portfolio. Remember, in previous weeks, we've proved the lower bounds for the options using different portfolios. So you can think that portfolio as a package. So basically, the portfolio contains different stuff, such as options, zero coupon bonds, and some of the underlying assets, right? So those things are bundled together and called packages. So basically, in the financial market, people financial engineer those packages, or the portfolios, if you like, so that they have very little upfront cost, okay? So let me say this again. The reason why people spend a lot of effort to engineer those portfolios or packages is to be more cost efficient. So for example, the option trading strategy is one good example of us combining different types of options in a portfolio. So in essence, we create a package. So remember back in week 4, we've created a bull spread, right? So remember the bull spread is about take a long position in a call option with the one that was the relatively lower strike price. At the same time, we short another call option with relatively higher strike price. So basically, what we did here is we established a strategy that is bullish on the underlying stock, and yet the cost is lower compared to only take a long position in the call option with the one that was the relatively lower strike price, right? And the same thing goes to the bearish strategy. So we long a put option, we short a put option. The reason why we did that is to lower the cost, right? The reason we did that is because we don't even think the underlying stock will go that low, so that's why we're going to short another put option. So that's some of the way that people package different options together to lower the cost. Okay, so basically package is all about bundling different instruments together, and by doing so, we achieve the cost efficiency. Okay, so the non-standard American option. So for a standard American option, you can exercise it any days leading up to and including the maturity date. Okay? So to value those standard American option, what we did back in week 5 is we used binomial option pricing approach, right? So basically with binomial option pricing approach, we work backwards from the right to the left, and we ask ourselves whether or not we want to exercise early at each knot of the tree. Okay, so that's with the standard American option. And one example for non-standard American option would be a Bermuda option. Okay, so with Bermuda option, rather than being allowed to exercise early at any point in time during the life of this option, you can only exercise it during a certain period. Okay, so let me say this again. Unlike American options that you have the full flexibility to exercise at any day during the life of the American option, with Bermuda option, you can only do the early exercise during certain period time during the life of this option. So just to imagine if you have a 6 months Bermuda option, right? So the maturity for the Bermuda option is 6 months, and you are allowed to early exercise it during the period from month 2 to month 3. Okay, so you only have the flexibility to do early exercise during 1 month out of the 6 months period. So what that means is that during the first month and during month 4, month 5, you cannot do early exercise. And you can only early exercise it during month 2 to month 3. So you must be wondering, what is the advantage of having this sort of Bermuda option, right? Why people would limit their flexibility to exercise at any point in time. So one obvious reason is that Bermuda option is cheaper. So it's a lot cheaper compared to your standard normal American option. The reason is because you give up some of those flexibility, right? And that would bring down the value of the option. So how do you value Bermuda option? So remember, when we value the standard American option, we use the binomial tree, right? So we work backwards from the right to the left. Then at each knot, at each branch, we'll compare the value of discounted value versus the intrinsic value. So the intrinsic value is simply representing the value you exercise that immediately. And the discounted value simply means the value you're holding on to that option for another time step, okay? So for Bermuda option, what you do is that for the period that you cannot access early, you do as what we have done for the European options. You simply discount all the payoff back within one go. And for the period which you can access early, you do the way which we have done for the American option, which is to compare the intrinsic value with the discounted value. Okay, so it's like a hybrid of American option and European option. Does that make sense? So with Bermuda option, you read the question carefully, you see which period you can access early, and you do the comparison between intrinsic value and the discounted value for that certain period. And for the rest of the period, you can simply discount back the option payoff. All right? So that's with the non-standard American option. Forward start option. So forward start option is a type of option you'll get it today, but the option will not come alive in 2 or 3 years' time. So the best example of a forward start option is an employee stock option. So usually companies' executives are granted with at-money option. However, they cannot do anything with those options for the first 5 or 10 years. Okay? So they only come alive after a certain period of time. So in terms of valuing the employee stock option, the example we have here is that imagine you've got an option that starts in 3 years' time. In other words, this option will not come alive in year 3, and this option would cease to be alive in year 5. Okay? So basically, this option has a life of 2 years. It come alive in year 3 and cease to be alive in year 5. So how do you value that? Basically, you just price it as a standard 2-year option. Okay, so this particular option would worth the same amount as a 2-year at-money option that initiated today. So there is no tricky stuff you have to remember. Again, what are some of the advantages that is associated with employee stock option? So, for example, if I'm the shareholder, and if I try to incentivize my employee or executives to increase the underlying earnings so that would increase the stock price, I try to incentivize them into the long term, right? So I don't want to try to incentivize them in the short term. So the advantage of that I mentioned, I remember back in week 4, is that if you just give the executive or employee the stock, the underlying stock, they can do some risky short-term investments, right? They can do some risky short-term investments to bump up the stock price, and then they can sell their stock and they can cash in. And usually the CEO or CFO have a tenure, right? So after a certain tenure, they leave the company, and then the company is loaded up with default risk. And with the employee stock option, because you cannot do anything for the first 5 or 10 years, so the manager interest is well aligned with the shareholder, which is to do a safe long-term investment project that would truly provide value to the company. Okay, so another type of forward start option is that you're worried about what's going to happen down the line, and you want to lock in a strike price today. So you can lock in the price by buying an option today. However, instead of buying the 5-year option, you can buy a 2-year option today, but doesn't come alive in 3 years' time. Okay, so again, this forward start option will be slightly cheaper compared to your normal standard 5-year option. So this is with the forward start option. Okay, compound option. So compound option is basically option contracts that are written on another option contract. So it's a bit similar to the futures option, which the option contract is written on the futures contract, and then the futures contract is in turn written on some underlying assets. Okay? So if you bought an option today and you exercise it, you will get another option. So basically, there are 4 types of compound option: call on call, put on call, call on put, and put on put. So basically, let's say if you have a call on call option, if you exercise it today, you would end up with another call option. So the risk associated with this sort of option is that they are highly sensitive to the underlying asset volatility. So you might ask, what's the purpose of compound option, right? So if people really want a call option, they could just buy a call option. So I guess the purpose of the compound option is very little. So this is a very good example of excessive amount of financial engineering, right? So if we go back with the forward start option, we see a point there, which is try to prevent short-termism of the managers. And if we have a look at the Bermuda option, we know the purpose is really to reduce the cost, and so does the packages option. I think the compound option is just the way that the investment bank creates some complicated products so they can sell to their client at a premium, and those clients would perceive this as a valuable sort of products. Okay, so, but the option on the futures contract makes sense because when you exercise the option, the futures option, you end up with a different financial instruments. So compared with the compound option, I think that the compound option doesn't have much real purpose. Okay, another type of exotic option is chooser options. Alternatively, is known as you like it option. All right, so with the chooser option, you have a generic option. At some point in the future, you decide what kind of option is going to be. So whether it's going to be a call or going to be a put. Okay, so let's think about it. Would a hedger ever want to buy a chooser option? What kind of trader is interested to buy chooser options? Would a hedger ever want to buy a chooser option? Basically, with chooser option, you have a generic option at first glance. Then after some certain period of time has passed, you can decide the nature of the option, whether it's going to be a call or going to be a put. What do you reckon? So let's think about what hedger wants. So hedger either owns the asset, they want to sell it sometime in the future. So if that's the case, the hedger surely wants a put option, right? Because the put option guarantees a minimum price the hedger can sell for. Alternatively, the hedger don't have the asset at the moment, but the hedger have intention to purchase the asset in some time in the future. Okay, so in that case, they want to buy a call option because what call option does is call option would guarantee a minimum price for the hedger to purchase the underlying assets. So hedger don't want to have this chooser option because hedger know what they want. They either want him to buy or they want him to sell. Okay, so speculators are more likely to purchase a chooser option. So for example, if speculator bought this option and a few months later, if the speculator see what's happening with the underlying asset price, so either call or put will be worth more than the original option they have purchased. So, for example, if the speculator holding this chooser option and after 6 months' time, the underlying share price decreased a lot, then the speculator would choose the option to be a put option, so they can arbitrage. Sorry, not arbitrage. They can speculate on the underlying assets. So alternatively, if the underlying asset price increased a lot, then the speculator can choose the option to be a call option, right? So they can buy the underlying asset at a really cheap price, then dump in the market for a profit. However, this kind of option is still risky in terms of whether the option will be valuable at the end. Arbitrageurs don't want to use the chooser option either because arbitrageurs want to establish their position very early on. Okay, so all of the position will be canceled off towards the end of the holding period. And it's hard to value the chooser option at the beginning. So when you decide which option to get into, whether it's a call option or a put option, that's when you get the certainty with the valuation for this option. So that's why the payoff with the chooser option is the maximum between either the call or put. So basically, you choose the one with the higher value. So how do I value this sort of option? Imagine if this is a 5-year option, and you get all of the variable you need, the risk-free rate, volatility, spot price, time to maturity. Then you find the price of a call option. Then you find the price of a put option. Then the price of the chooser option will simply be a probability-weighted average of the call and put option price. And obviously, the probability to figure out whether it's going to be a call or put is going to be very difficult. So I'm not expecting you to know how to price a chooser option. Okay, but you just need to know that the payoff is the maximum between either a call or put. Depends on the time of the underlying asset price. Okay, another type of exotic option is barrier option. And there are two types of barrier option. There's knockout option and knock-in option. Okay? So first, let's have a look at the knockout option. There are 4 types of knockout option. So for example, with the first one, the up and out call option, basically this call option is alive at the beginning, just like any other normal call option, and it gives you the right but not the obligation to purchase the underlying assets. So if the underlying asset price reached to a certain level, then this option would cease to exist. Okay, so basically means this option would die. Imagine the current stock price is $10, and a knockout price, the barrier price is $20. So as soon as the share price hits $20 barrier, then this option would die, would cease to exist. Okay? So what is the advantage of a barrier option over a traditional standard call option? Again, the reason is the cost. So the barrier option is cheaper because it would cease to exist beyond certain point in time. Okay, so as an investor, why would I buy an up and call barrier option? Apart from the fact it's cheaper. Because the same reason as the investor would set up a bull spread, so a lot of investors think that underlying share price would increase, but they don't think the underlying share price would increase that high, okay? So that's why they would buy a barrier option that's more cost effective, right? Because with the up and out call option, when the share price hits the certain barrier level, the option ceases to exist, okay? So whoever purchased that option don't even think the share price can hit that level. So that's why they buy this barrier option, and it's cheaper compared to a normal standard option. Okay, so let's think about down and out call option. So if the price falling to a certain level, then this option would cease to exist. All right, so let's think about the rationale for people who are buying the down and out call option. If the underlying asset price is really decreased to that low level, then you never really need to use the option anyway. You can simply buy the underlying asset at the market price, because at the time the market price is going to be really low. So that's the purpose of down and out call option. And then we have up and out put option and down and out put option. So basically when the price go up to a certain level, then this option would cease to exist. If the underlying asset price going down to a certain level, then this put option would cease to exist. So similar to the example I gave you about the knockout call options. And the other 4 type of the barrier option is knocking option. So basically with knocking option, at the beginning, the option does not exist. All right, so the option does not exist in the first place. But when the price reaches certain barrier level, then the option would come alive. So for example, with an up and in option, once the underlying asset price hits certain level, then this option would come alive. So if it is a down and in option, when the price decreases to a certain level, then this option comes alive. So advantage for up and in option is I can buy a really cheap call option, and when the price reaches to a certain level, at first glance, it's bad for me if I was intended to purchase the underlying asset, right? Because I was planning to buy this asset at a low price. But that's okay, because once the share price hit the barrier level, go up to the certain level, then my call option comes alive. Then I can exercise my call option to buy the underlying asset at a really low price. So that's how the knocking option works. With the knockout option, the options are currently alive but cease to exist when the price hits certain level. But with the knocking option, the option is not alive at the beginning, and when the price reaches certain level, then the option would become alive. So how do we value this sort of barrier options? So again, you find all of the underlying variable you need, the risk-free rate, spot price for the underlying assets, the volatility of underlying assets, you have a strike price plus a barrier price, okay? Then you ask yourself, so basically, first of all, you value the option as what you have done for the traditional European option. Then you figure out the probability when the price would hit the barrier. Then you discount the option price with that probability. Okay, so that's roughly how people value the barrier option. Okay, so barrier option. And then we have another type of exotic option called look-back option. All right, so with look-back option means at the beginning, the option doesn't have a strike price. So you don't know what the strike price is going to be at the beginning. For instance, if we look at this look-back call option, instead of having the payoff of the final spot price ST minus the strike price K, we have the spot price minus the minimum price. So basically, this minimum price represents the lowest spot price occurred during the life of this particular option. So let's assume if this option has a life of 1 year and it starts 1st of January and expires on 31st of December. So you take the final spot price on 31st of December, and then you subtract the lowest spot price that you observed over past 12 months, okay? So that enables you to lock in the lowest price during the life of this particular option. So that's the look-back call option. And look-back put option would enable you to lock in the highest spot price during the life of this option. So basically, you can sell the underlying asset at the highest spot price that you observed during the life of the look-back put. So again, instead of having a payoff written as the K minus ST, so remember in your normal put option, we have K minus ST, which is strike price minus the final spot price. Here we have the maximum spot price you observed during the life of this option, then minus the final spot price. So that is the payoff for the look-back put. So this is an interesting option. It's called short options. So, okay, so one more thing I would like to mention about the look-back option is that the question is, would look-back option be more expensive than your regular option? It depends. So basically, it depends on the strike price. So imagine if the current spot price is 100, and if you have a strike price $10, then you have a dip in the money option. So the regular option will be very expensive. And for this option to be compared with a look-back option, you would expect how likely the spot price falling below 10 during the life of the look-back option. Okay, if it's less likely to falling below 10, then the look-back option is obviously cheaper compared to the standard option. Alternatively, you might have a at-money option where the current spot price is 100 and the strike price is also 100, so this is at-money option. And this at-money regular option would probably selling at a lower price compared to our comparable look-back option. Because we know with a high volatility in the underlying assets, you can expect the asset price can easily fall below 100. And once it falls below 100, that's going to be your strike price. So in other words, it's not certain that look-back option will be cheaper compared to your regular option. It really depends on the time of the strike price. Right, so short option is an interesting exotic option because, so basically, the way how short option works is there is a European option, and the holder of this European option can short to the writer of the option at once during the life of this option. So let me say this again. So if you bought a short option, you can shout out to the writer of this option only once during the life of this short option. So basically, at the end of the option life, the option holder would either end up with the usual payoff from a European option or an intrinsic value at the time of the short, so whichever is greater. So here is a payoff equation for the short option. So suppose we have a short call option, and suppose the strike price is 50, okay? Strike price is 50, so the X is 50. And imagine the holder of this short call option short to the writer of this option when the underlying asset price is 60. So this S tau represents the price when the option holder shouted to the writer, okay? So imagine this S tau is $60. Now, so at the maturity date, the spot price is $70. So the final spot price is 70. So the ST is your final spot price. So what you're going to get is first the price difference between the price that you shouted minus the strike price. All right? So the strike price is 50. The time you shouted is 60. So that's 60 minus 50, that's $10 payoff. That's one component. And the other component is the price difference between the final spot price and the price that you shouted. So the final spot price finished at $70, so $70 minus 60. So 60 is the price that you shouted. So that's another $10 payoff. So that's $20 payoff to the holder of this short call option. So that's the short option. We have American options and we have European options. Then here we have Asian options. Okay, so Asian option, there are two types of it. The first is called Asian price option. And the second type of Asian option is called the Asian strike option. All right, so let's have a look at the Asian price option first. So basically, instead of having a strike price that's well defined in the option contract, what you do is you take the average price of the underlying asset spot price during some part of the life of this particular option. Then you're using the average price as the strike price. As the final spot price. So let me say this again. So instead of using the final spot price to minus the strike price, what you do is you take an average of the spot price during certain period time over the life of this option. Then you're using that average price to work out the payoff. Okay? And similarly with a put price option, what you do is that you take the strike price minus the average price, average spot price of the underlying asset. And that is going to be your payoff for the Asian price put option. Now with the Asian strike price option, you don't have a well-defined strike price at the beginning. So again, what you do is you take the average of the spot price during certain periods over the life of the option, then that serves as the strike price. Then you're using the final spot price minus the average price to work out the call option payoff. Alternatively, you're using the average price minus the final spot price to work out the payoff on the put option. All right, so what the advantage of Asian option over the European or American option? So first of all, the Asian average price option is less expensive than your regular option, and they are more appropriate to meeting the needs of corporations. Okay, so basically, the regular option to the corporation seems a bit ad hoc. So if we think about from the corporation's point of view, so imagine we have a US corporation, and the company's CFO is thinking that we expect to receive a cash flow of 100 million Australian dollar spread evenly over next year from company's Australian subsidiaries. All right? And the company CFO wants an option that would guarantee an average exchange rate that realized during the year that's above certain level. If that's the case, then the average price option, the average price put option will be more suited to this corporation's CFO, right? Because the company doesn't really care about one particular price, but really what they want is to try to average out the price evenly over the next year. So that's the advantage of the average price put option over your regular put option. So they are more utilized by big corporations. Okay, then we have option to exchange. So basically, option to exchange is we exchange one asset for another asset. Basically, the option to exchange would have different purpose in different contexts. For example, one way people utilize the option to exchange is to hedge the foreign currency risk. So for example, we can have an option to buy Japanese yen with Australian dollar, and from US investors' point of view, that is an option to exchange. And another example is a stock tender offer. Okay, so standard stock tender offer is the option to exchange the share in one company for shares in another company. Right, so that's another example of option to exchange. So again, this is more utilized by big companies because company wants to diversify. One good example I can think of is that imagine we have the airline company Qantas, right, and then we have British Petroleum, an oil company. Okay, so we know that the airline company's biggest expenditure is the aviation fuel, right? So whenever the oil price goes up, the aviation fuel price goes up, and the airline company profits goes down. And one thing the company could do is they can exchange some of their shares or exchange some of their assets. So when the oil price goes up, although the airline company suffers from a higher aviation fuel cost, but it also benefits from the share price increase in the oil company, right? So that works as a diversification kind of tool for the corporations to hedge their exposure. So that is the option to exchange. Okay, mortgage-backed securities. So basically, mortgage-backed security is one type of asset-backed security. So mortgage-backed security is usually secured by a mortgage or a collection of mortgages. So imagine when people take out mortgage from Commonwealth Bank or maybe Westpac, the bank don't want that exposure. So all they wanted to do is to get their money back as soon as possible. So what bank did is they usually pool those mortgages together and they bundle it, they divide into different classes, then they sell to the institutional investor. So by doing so, the bank effectively attempt to shorten their liquidity cycle. Okay, so so as I mentioned before, what banks do is that the bank would have a whole lot of mortgage and then would pool them together and they would divide into different classes, then they sell to outside investors. So they try to make those mortgage off their balance sheets. So the main difference between mortgage-backed security and the other type of generic asset-backed security is that mortgage-backed security is usually guaranteed by a government's related agencies. So for example, in the United States, the Federal National Mortgage Association usually back up those mortgages that sold in the market. So basically, investors have a sense of security that they are protected against default. This may make the mortgage-backed security sounds like a regular fixed income security, but in fact there is a critical difference between MBS and other regular fixed income investments. So the main difference is that the mortgage in the mortgage-backed security pool have this prepayment privilege. Okay, so the prepayment privilege basically is quite valuable to the household because the household would always want to refinance their mortgage when the interest rates are low, so they would just repay all of their mortgage in advance. Then they would refinance it at a lower mortgage rate. So let's say in Australia, a mortgage typically lasts for 30 years, okay? And that mortgage can be prepaid at any time. So this means that the household would have a 30-year American-style option basically to give their mortgage back to the bank at its face value. So in terms of, for somebody who try to value the mortgage-backed security, the prepayment is sort of risk, right? And also one difficult thing is that the prepayment function is very unreliable, and is not a reliable predictor of the actual prepayment experienced at individual mortgage level. So that's why people pool all the mortgage together. The people would pool similar mortgage together. Then there is a law of large number effect at work, and then the prepayment can be predicted with more accuracy. Okay, so as investors, we can buy mortgage-backed securities, we give the money, and in return, we expect two things. We expect the interest payments, and we expect to get our principal back, okay? So that's when I want to talk about a collateralized mortgage obligation. Basically, so let's go back to the mortgage-backed security. So the simplest type of agency-backed mortgage security is that all investors would receive the same return and bear the same prepayment risk. But not all the mortgage-backed security work in this way. So one example is a collateralized mortgage obligation. So CMO. So basically, CMO, the investors are divided into a number of classes, and there are rules and policies developed to determine how the principal repayments are channeled to different classes. Okay? So a collateralized mortgage obligation would create classes of securities that bear different amount of prepayment risk. So one example is to consider an agency-type mortgage-backed security where investors are divided into three classes. Right? We have Class A, Class B, and Class C. And all principal repayments, so including those pre-scheduled and those prepaid, are channeled to the Class A investor first. After the Class A investor has been completely paid off, the remaining money would go to Class B investor. Then after all of the Class B investor get paid off, the remaining money goes to the Class C. Okay, so by construction, the Class A investors expect to last shorter amount of time than Class B investor because they are the one who get paid first. Then the Class B investors expect to last for a shorter period of time compared to the Class C investor. All right, so objective of doing this slice and dice to divide the investor into different classes is try to make that more attractive to institutional investors, okay? Because institutional investors try to match their assets with their liability for different maturities. So they would want to have a finer classification of the mortgage-backed security. So that's why people do that. So that is with mortgage-backed securities. And let's have a look at some of the non-standard swap. So basically, in week 3, we've done the plain vanilla swap, okay? But that's just one type of the swap. There are other different types of the swaps. So for non-standard swap, I'm not expecting you to know the design of the swap, except for the currency swap, you have to know that. So basically, for the non-standard swap, you only need to know the definition and what they are. Okay, so the first non-standard swap is a step-up swap. So the way how step-up swap works is that originally, you might want to borrow in $10 million. All right, so then a couple of years later, you might want to borrow a higher amount, let's say 20 million. Then towards to the very end of the stage, you want to borrow even more. So let's say you want to borrow 30 million. So basically, you are borrowing money at an increasing amount as you go through time. So the step-up swap is well suited for somebody who is building an infrastructure project. Okay, so imagine when a company tries to build a large toll road, initially the project might cost them $10 million. Then as the project goes along, it might cost increasingly more. So that's why you need to borrow increasingly more towards to the later stage. So for the amortizing swap is the opposite. So for example, for the same toll road project, when it comes to repaying the loan, you can swap it into a amortizing swap, because once the toll road has been completed, your expenditure went down dramatically. So all you need to do is to simply maintain the road. Okay. Now you have all the money coming in from the toll road, and you can start to pay off the larger amounts of the loan at the beginning. Then your repayment is decreasing through time. So one thing worth noting is that in our plain vanilla swap, for the floating rate, the reference rate is always the LIBOR rate. But for the non-standard swap, the reference rate can be anything, right? So the example given here is that the reference rate can be a commercial paper rate. Okay, compounded swap. So compounded swap is that rather swap the payments every 3 months or every 6 months, you don't swap those intermediary payments with compound swap. Okay, so all of the payments are made at the end of the swap. So all of the payments are swapped at the end of the swap life. So you can imagine that a compound swap has higher credit risk compared to your standard swap, right? Because with standard swap, all the payments are swapped, let's say every quarterly or semi-annually. Then you can check your credibility of your counterparty from time to time. But with compound swap, the credit risk is reviewed towards the end of the swap. So compound swap is quite risky. And then there are swaps, currency swaps, as we discussed back in week 4. So one type of the currency swap is fixed rate for fixed rate currency swap, right? So we have done one example on the fixed for fixed back in week 4. So I will try to find other examples of currency swap. Then I'll talk you through in Thursday's workshop. Okay, so there is also floating for floating currency swap. And another type of non-standard swap is called LIBOR in arrears swap. Right? So in week 4, we've talked about the coupon payment for the floating rate bond is determined in a previous payment date. Right? So for example, if today is the coupon swap date, if today is the payment date, there are 2 things happen. First, I'm going to get my coupon today. And the second thing happened to me is I will be told the value of my next coupon based on whatever the market floating rate that is observed today, right? So let me say this again. So in the plain vanilla swap, in the payment date, 2 things happen. First, you'll get paid your floating rate coupon. That's one thing. And the second thing is that you'll be told by your counterparty what your next coupon will be based on the prevailing floating rate that you observe in the market today. So basically, the LIBOR in arrears swap is kind of a swap where you don't know the value of your coupon until the day you receive it. So the floating rate coupon you receive will simply be the floating rate on the day that you receive the coupon instead of knowing that coupon in advance. So that's basically what LIBOR in arrears means. And then we have constant maturity swap. So rather having the rate changes every 6 months, we would say that we would use a 5-year swap rate, 5-year rate, as the base rate, and that rate would determine for all of the subsequent coupon payment. So instead of having the floating rate coupon flows over the time, that floating rate would fixate it to a certain rate. So that's called constant maturity swap. And there is differential swap. So basically, this is the interest rate swap. You apply the floating interest rate in one currency to the principal of another currency. So again, this is for the purpose of hedging off the foreign currency exposure. Okay, so we have an equity swap. So I'll give you guys one example in Thursday workshop of how equity swap works. So remember, in our plain vanilla interest rate swap, you swap the fixed rate for the floating rate. With an equity swap, instead of swapping the fixed rate with the floating rate, you swap the fixed rate with a return on a stock index. Alternatively, you could swap a floating rate, the LIBOR rate, for a return on a stock index. So the return on the equity index is defined as the total return. So the total return means that the index dividends is reinvested in the index itself. So the dividend yield is included as part of the return. So that's the total return to be swapped. So that's the equity swap. Then we have accrual swap. So accrual swap is when the floating rate is moving in a tight range. Okay, so whenever the floating rate is moving in a tight range, then whoever is responsible for paying that floating rate, they don't have to pay. So basically, all of the floating rate coupon would accrue over time. However, when the floating rate starts moving in a large range, then the party who is responsible for paying the floating rate, they need to start to make out those floating rate coupon to the other party. Not only they need to pay them the floating rate coupon, but also they need to pay any interest accrued on those coupons. So that's why it's called accrual swap. And then we have a cancelable swap. So as the name suggests, it's just a plain vanilla swap, but one party have the right or have the option to cancel or terminate the swap after a certain period of time. So usually it's after one or more payments, then this option to cancel kick in, and one party can terminate the swap. So it's called cancelable swap. Okay, so one last one. One last two. So we have a indexed principal swap. So this swap is similar to a amortizing swap, where the principal decreases over time, and the magnitude of decrease depends on the magnitude of decrease in the interest rate level. And then we have the commodity swap, which is swapping the cash flow on certain commodities. So for instance, you can swap the return on a fixed volume of coal for the return on the same quantity of iron ore. So that's people used to hedge the commodity risk exposure. So that's the commodity swap. Okay, so basically we finished so if you like, we finished all of the definitions for the exotic options. And we're going to have a 10 minutes break. And after break, I'd like to go through a final exam papers. So this is the final exam paper taken from the second semester of 2012. And we're going to go through this paper. And and I'll demonstrate how to efficiently use your time in the final exam situation. All right, so let's have 10 minutes break, and we'll start to do this exam paper 10 minutes later.
for this brief lecture is just about theory.
All right, guys, so let's get started. During the break, a couple of students come up to me, say, how much you guys expect to know from today's lecture. So first of all, your quiz next week is a theory question. It's a definition question based on today's content. All right? So there's no numerical quiz for today's content, but there will be a definition question. So you're going to get a definition question based on exotic options. So that's the first thing. And the second thing is that for the final exam exotic option, you probably will not get any of those exotic options. So the chances are you're going to get an exotic option that's just made up option. And it's your responsibility to figure out what is the payoff from those options. So examples such as the one we have done in the last week. So remember, so this is the lecture slides from last week. After the conclusion, I posted 2 examples. I said I've given you this Canberra option, which is a made-up option. Or maybe you were given some other weird named options. So basically, for the exotic option in the final exam, you probably will not get any of those that I just mentioned, okay? So all of those options I mentioned today will be examinable in terms of the definition or the theory. But in terms of the numerical one, you will get one that's made up by me, okay? So basically, you have all the tools to figure out the payoff of that exotic option, but you just need a bit of effort to figure it out. Does that make sense? Okay? So in terms of the numerical example for exotic option, go back to the last 2 examples I covered in the previous week. Okay, what else? One thing I want to mention is that although we had mid-semester test, which examines from week 1 to week 4, but the final exam would still cover the material that we covered in week 1 from week 1 to week 4. Okay? So you need to revise everything, in other words. And also, remember the option trading strategy we taught, it was not examined in the mid-semester test, and it is examinable for the final exam, okay? The option trading strategies. What else I need to talk about? Okay, so how about we do a final exam paper together and get a feel of what the final exam is all about. So for example, before we start to do the question, so the first question is a futures option. So we've done that in week 8. And the second question is a delta hedging question, which we've done that last week. And then sometimes the exam question would throw you some theory questions, say, what does the term of delta hedging mean, right? So, and then the third question is simply a binomial option pricing, but then you see you get thrown at some definition question from this week. What are 2 types of Asian coal options, right? So that's sort of question you would expect. And then lastly is simply a currency swap question. Okay, so we did currency swap back in week 4. We did the binomial back in week 5. So yeah, so the first 5 weeks will still be examinable. You need to revise everything, including the option trading strategy. Okay, so let's have a look at the first question. So I've rewritten this question in my slide because it's quite hard to read. So the first question says, you have been given following information about a European put futures contract. So the option has a life of 11 months, and futures contract underlying the option has a life of 1 year. Right? So right away, we know that the 1 year is a redundant information we don't need. And the option has a strike price of 72. The current futures price is 61.50. Risk-free rate 3%, compounded quarterly. If the put futures option contract is currently selling for $7.50, identify an arbitrage opportunity and detail in words how would you make an arbitrage profit. So we've done that in week 8 workshops. So the first thing you have to do is to convert that quarterly compounding interest rate into a continuously compounded rate. And next thing you do is you need to use the lower bound formula to check whether or not the lower bound for this particular put option is violated, right? So we know the strike price is 72, and we know the current future price is 61.50, and we discount back 11 months. So 11 months is the life of the option, and we discount it using the continuously compounded rate. And we realize that the $7.50, which is the current price of this put option, is lower than the lower bound, right? So if it's lower than the lower bound, means that our lower bound is violated, and that presents an arbitrage opportunity. So we can do something today to arbitrage away the price difference. So how can we arbitrage this? As I mentioned, your arbitrage strategy would entirely based on this lower bound equation. So what is in our lower bound equation? We have a put option in the left-hand side of the portfolio. Not only we have a put option in the left-hand side, we also have a futures contract, right? We also have the futures contract in the left-hand side of the equation. The reason why we didn't write it is because it costs you nothing to enter into a futures contract today. So that's why we didn't write it. But you should know, implicitly, there is also a futures position associated with the left-hand side equation. So basically, we long the underpriced put option, right? We buy low, sell high. We buy this underpriced put option together. We're going to buy a futures contract. So what we're going to short? How can we finance this purchase? We're going to short in the entire right-hand side of the equation. So what is in the right-hand side? Now, originally, in the right-hand side, we have a long position in the zero coupon bonds that provide a payoff of X, and we're going to short another zero coupon bond that provide a payoff of F0. Now, we're going to do the opposite. Instead of longing the zero coupon bond with X, we're going to short the zero coupon bond with the face value of X. And instead of shorting the zero coupon bond with face value of F0, we're going to long the zero coupon bond with face value of F0. So that's precisely what we did here. Basically, we borrow the present value of the strike price. So that's the strike price discount back to today. And then we're going to invest the money in the present value of the futures price. Okay? Basically, we're going to buy the zero coupon bond that provides a payoff of F0 at the end of the maturity. So once we set up this strategy, we detail all the cash flow at different point in time. So today, at the present, we're going to borrow the present value of the strike. So we're discounting the strike price. Strike price is 72. Discount back to the present is roughly $70. We're going to borrow that amount, and then we're going to invest at the present value of the futures price. So that's the future price discount back to the present, and then the remaining money goes to purchase this put option. Okay, so after we purchase the put option, we still have $2.71 left. So that's the arbitrage profit I made today. And going forward 1 year, because we long a put option, if the futures price that's greater than the strike price, then we don't exercise it, right? And the payoff from the long futures contract provide us a payoff of FT minus F0. So F0 is 61.50 cents. We borrowed this much 11 months ago, and now it's the time to repay the strike price. So we're going to repay $72, and we invested the present value of the futures price, and now it's the time for us to get the payoff back. So we're getting 61.50. So if you sum up this column, you realize it comes down to FT minus $72. So because the futures price is higher than 72, so we're going to make even more profit when the futures price finish higher than 72 strike price. Okay, so alternative scenario is where the futures price finish lower than 72. If it finish lower than 72, then we exercise the put, we get a payoff of 72 minus FT. Their student email me, ask me, says, I know that if we loan a put option, if we exercise the put option, we're going to be paid the cash amount of 72 minus FT. But at the same time, I would also end up with a short position in the futures contract. What should I do with the short position in the futures contract? Well, implicitly, you close off the futures contract at the day that you get it. So let me say this again. So 11 months later, when you exercise the put option, you get paid the cash amount of 72 minus FT, right? So that's the first thing you get. The second thing is you got a short position in the futures contract, right? So here we kind of implicitly assume that we close out that short futures contract by entering into a long futures contract at the same time. So in other words, we don't have the short position in the futures contract. And then we have a long futures contract, which is FT minus the F0 price. We know F0 price is 61.50. And again, we need to repay the money that we borrowed. Again, we're getting the payoff that we invested. So if you sum up this column, it comes down to 0. So basically, we make an immediate profit of $2.72 today, and going forward 11 months, we have more potential to make more positive profit if the FT price finish higher than 72. So that's the first part of your question 1. And the part B says, a share in Wesfarmers is currently selling for $34.52. The dividend yield on Wesfarmers is 3%, continuously compounded, and risk-free rate is 1% per quarter. Okay, so the 9 months American call option on Wesfarmers with a strike price of 32 is currently selling for $5. So the question says, calculate the boundaries for the price of a 9 months American put option on Wesfarmers with a strike price of 32. So what we are given here is we're given American call option. We know how much it's selling for, and we also know the maturity, right? And we also know the strike price. And it just so happened that we have American put option with same maturity and the same strike price. The only thing we don't know is the selling price for this put, okay? So as I mentioned earlier, it's a perfect scenario to set up American put-call parity formula. Because with the American put-call parity formula, that's precisely dealing with you having a call, you having a put. They have same maturity, same strike price, and you only have one price for one of the option. I guess the only tricky part with the part B of the first question is that we need to convert the periodic rate into annual effective, okay? Because this is given 1% per quarter, right? So we convert the periodic rate into an annual effective rate. Then we know the current spot price, $34.52, and we need to remove the dividend yield from the current spot price. So the dividend yield is 3%, right? So discount back 9 months minus the strike price. And we know how much this call option is selling for. The call option is selling for $5. We don't know what the put option is selling for. And then we know what the spot price is, and we know what the present value of the strike price. Okay, so then this just reduced to this equation here. The next thing I did is I subtract $5 on both sides of the equation, so I end up with this, right? The next thing I did, I simply flip the both sides, then I get the boundary condition for this American put option. Yes? There's actually portfolio strategy to derive this entire American put-call parity, but it's too complicated, so it's not covering this course. Yeah, I know it looks there's some sort of pattern going on here, right? There's a pattern because it's actually also derived from portfolios, okay? But that was not examinable. So, yeah, so you just need to remember that on the left-hand side, you just this minus the strike. On the right-hand side is the spot price minus the present value of the strike. Yes? Yes, you need to remember this formula, okay? You need to remember this American Poco parity formula. But everybody understand that how this equation was rearranged and get the final boundaries. Okay, so basically this put option should not be selling lower than $1.53 and should not be selling higher than $3.24. Okay, so that's the part 2 of question 1. What else we need to do with the first part of the question 1? Okay, what is delta? All right, so what's the delta on the loan futures contract on a dividend paying stock? I gave this equation last week. So this is quite straightforward, so that's why I didn't include it in the slide. So go to your previous lecture slide to check out the delta for the futures contract on the dividend paying stock. A lot of people ask me, say, why the delta on the forward contract is supposed to be 1? So as I mentioned, the forward contract, the value is determined by the spot price minus the present value of the delivery price, right? So that's the way how we revalue the forward contract. Now, because the delivery price is kept fixed, the only thing that changes is your spot price equation, right? Now, if the spot price go up by $1, of course, your forward value go up by $1. So that's $1 by $1. So if you plot the value of the forward contract value against the spot price, you find they have 100% positive correlation. So that's why the forward contract automatically has a delta of 1, right? That's a long position in the forward. Now, if you short forward, that's -1. Okay? Now, with the futures contract I mentioned, is similar to the forward case. The original delta should be 1, but then again, because we're earning an income yield on our margin account associated with this future contract, so that's why we need to remove the risk-free rate from the delta of the futures contract. Okay, so the second question, let's have a look at the second question. So the second question says, an Australian bank is concerned about exposure to its portfolio of shares in David Jones. So the bank called you to advise how they can make their portfolio of shares in David Jones delta neutral. So Australian bank sold 100,000 put options on David Jones with a strike price of $2.60, and each option is for 15 shares in David Jones. So the put option has 8 months to expiry, and the current share price of David Jones is $2.55. So David Jones share is currently paying a dividend of 2%, risk-free is 3%, both continuously compounded, and the volatility of the share associated with David Jones is estimated to be 27% per annum, continuously compounded, and the put option is currently selling for 50 cents. So advise the Australian bank to make this portfolio delta neutral. So first of all, let's think through this. What is the delta on the long position in the put option? Positive or negative? What is the delta on the put option if you take the long position? It's negative, right? Now, we short put option, do we have positive delta exposure or negative? We have positive, right? And we try to get rid of that delta exposure. How can we get rid of the positive delta exposure? Yeah, we short the underlying assets, right? Shorting the underlying assets creates negative delta. So that's our strategy. Now, we know the way we calculate delta is based on the D1 equation from the modified Black-Scholes D1 equation. The only modification here is to subtract the dividend yield from the risk-free rate. And then we know everything, we know all of the parameters. For example, we know that the spot price is $2.55, the strike price is $2.60, risk-free rate is 3% minus the dividend yield 2%, and that's the variance divided by 2 times time to maturity. And in the denominator, we have sigma times square root of time t. Okay, so we get 0.05, and simply go to the table with the positive value. 0.05 is associated with delta of 0.5119. So that's the delta on the long position in a European call option. And we know that delta on the European put is simply ND1 minus 1. And what's more complicated is this is the asset that pays the dividend yield. So furthermore, we need to remove the effect of dividend yield from the European put option. And what's even more is that this is the delta on the put option if you take a long position. Now, because we short put, we need to put a minus sign to remind us the delta exposure is positive. So 0.511 minus 1 and negative sign in front of that. Again, we need to remove the dividend yield, 2%. So we get delta for each put option is 0.47. And because we shorted 100,000 put options, and each put option covers 15 shares, so that's why we need to short this much David Jones shares. Okay? So quite similar to what we have done last week. So that's question number 2. And the part B of question number 2 says, using the Black-Scholes model, calculate the price of a 5-month at-money put option contract. Okay. The futures contract underlying the option is on shares of Qantas, whose current price is $1.80, and the 5-month put futures option contract has an exercise price of $1.90, its volatility is 35%, risk-free rate is 4.5. So all of the rates are continuously compounded, all right? So again, in the final exam, I only provide you the basic Black-Scholes formula. It's your job to modify the D1 equation, right? So the way we modify it is quite simple. We replace all of the spot price with the futures price. So we replace S0 with F0. And what's more is that we don't have to worry about the risk-free rate because risk-free rate reduced to 0. The reason I mentioned is because you need to subtract the risk-free rate from risk-free rate, so the risk-free rate is cancelled on the right-hand side of the bracket. So this is your D1 equation. And we were told future price is $1.90, strike price is also $1.90. And that's the variance times the maturity divided by 2, then divided by sigma times square root of time t. We get D1 value. Then we're using the D1 value to work out D2. Remember, in this question, we were asked to calculate the price on the put futures option, right? So if you remember the put future equation, we're really interested in finding n minus D1 and n minus D2, okay? So that's why we need to find the probability for minus 0.11 and positive 0.11. So go to your table, find n minus D1, n minus D2. Then the next thing is that that's the present value of the strike times n minus D2 minus the present value of the future price times n minus D1. Then we'll work out the put option should be selling for 16 cents. Right? So this European put futures option on Qantas should be selling for 16 cents. Okay, what else? Okay, so here is one theory question, right? So what does the term of delta hedging mean? Alternatively, I can ask you, please detail the issues that people encountered with using delta hedging, or what are some of the problems associated with delta hedging, and provide your answer in bullet points, stuff like that, okay? So only half an hour, we already finished half of the paper. So I would expect you guys would have plenty of time in the final exam to check your answers, okay? Now the third question, let's have a look at the third question. So the third question says, ASX ordinary index is currently at a level of 4,520 points. And also you have done some analysis and you estimate the volatility on ASX is 18%, risk-free rate is 3.25%, dividend yield on the index is 5%. So all of the rates are continuously compounded. The question says use a two-step binomial tree to value this 8 months American put option. Okay, so assume that each time step is for 4 months, and the option has a strike price of 4,600 points, right? So basically, I would expect you to remember the equation, the formula for calculating little u and little d, okay? Because the proportional increase and decrease may not be provided in the final exam, so you need to remember this. Okay, we know that equation for calculating u is simply e to the power of sigma times square root of delta t. So using delta t here, don't use the maturity. So delta t is 4 months, 4 over 12. We get proportional increase, and 1 over that give us proportional decrease. All right? So the next step is to draw the binomial tree. So we start with the current level, 4,520 points, and that multiplied by u give us the points here. And we take this current level multiplied by little d, we get points down here. Then you repeat the same process to complete the tree, all right? And in this question, we are given a put option, right? We're given a put option with the strike price of 4,600 points. Right, so we need to work out the payoff at each terminal point. So at this point, the put option is out of money, right? Because the spot price is greater than your strike price. So when the tree finishes in the middle, it is lower than our strike price, so 80 points lower. So the payoff from the put option is 80. And down here, our put option is deeply in the money, and you're using 4,600 minus this, you get the put option payoff is 928. Then you need to calculate the risk-neutral probability. So this is the option based on indices. So the indices provide a dividend yield. When you're calculating your risk-neutral probability, remember to subtract the dividend yield Q from the risk-free rate. So that's what we have done here. Then multiply by delta D, T, then then subtract the D divided by the difference between U and D. So we calculate the probability going up and the probability going down. So in the quiz you have done last week, I realized a lot of people, when they calculate the payoff at each of knot, they don't use the probability to times the payoff. They're using the little u and the little d to times the payoff. Then they just completely ruin the question, right? So when you're discounting the payoff, you need to use the probability, right? Because here, so we're standing here, we're thinking, what would be the discounted payoff, right? So first of all, we need to work out expected payoff. Expect payoff is simply the probability of that happening times the payoff, you end up there, right? So that's probability going up times 0 plus the probability going down times 80. So that's what I did. And again, we need to compare this discounted value with the intrinsic value in knot B, okay? So intrinsic value is simply this points compare with the strike price. So it's higher than the strike price. The put option is out of money. So you need to write a little sentence say that we choose to hold on to this option rather than exercise early in knot B. Right? If you don't write this sentence, you lose mark. Okay, so we repeat the same process for the knot C. That's basically the probability of going up. Then you get the payoff of 80 plus the probability going down. You get a payoff of whopping 928.
discount back 4 months, and then again we need to compare that discounted value with intrinsic value. So the intrinsic value is the strike price subtract the price at node C. We realize that intrinsic value is only worth 526. So again, we don't exercise early. We choose to hold on to this option because holding on to it gives us higher value. Again, you need to state your decision making in node C. Then the one last step is simply discounting everything back to node A, right? So this is the value that we discounted from node B, and that's the probability going up. That's the discounted value that we discounted in node C, and that's the probability going down. We discount back 4 months, and even back in node A, you still need to compare this discounted value with the intrinsic value, okay? So the intrinsic value is 4,600 minus 4,520, so that's merely 80 points. So that's why we choose this to be the price of this put option. Again, you need to write a sentence to state that you did the comparison. And finally, don't forget, this is expressed in points. You need to multiply by the $25 multiplier. Okay, so that's the part C. Then the second question of, sorry, that's question number 3, part 1. So the part B of question number 3 is a definition question, which we covered today. Okay, so I want to utilize more time to go through question number 4. So we're going to do question number 4 in Thursday's workshop. But as you can see, we spent like 40 minutes to finish majority of exam papers. So in the final exam paper, you would have plenty of time to finish the exam paper, plus extra time to check your work. Okay? So I will post this final exam on Woto. Thanks, everybody.
Okay. Right. Now you're behaving yourself.
This place string is going to give and view, and this string out.
Yeah, so basically this entire equation was derived by a portfolio. So, yeah, so if you do that step by step, you're going to end up an equation on the two sides.
Because always we always like use the r minus q. Why in this question we not just use r minus q in both sides?
Okay, don't bother. I'll tell you guys, this you don't need to remember, okay? Because I didn't cover the
But I
derivation.
can't understand it.
Yeah, okay. So I'll make announcements, all right? So in week 12.
Okay.
Yeah. Any other questions?
Yes. I asked you about the delta.
Oh, you asked me. Okay,
Yeah.
yeah.
And I think I want to know why your delta has a minus, because in textbook there is no minus. This is my first question.
Yeah, so basically, the textbook just using that divided by whatever delta.
Yeah.
So you put a minus sign similar times the exposure, same as dividing that.
But if like we calculate a delta for a portfolio and it contains a futures contract, we need to use your delta or the text.
Use my delta. Please use my delta.
Why?
Because my way is more intuitive. So basically, all I'm saying is that future contract is supposed to have delta 1.
1, 2.
But because it provides income, so the delta is in fact less than 1. If that's the case, then you're using a small amount to multiply by the exposure.
But the definition of delta is the derivative of the payoff.
Yes.
The
No.
derivative
The
of
definition of delta is the sensitivity of
Yeah.
future price with respect to the change of underlying asset.
So what about me? So if I'm lecturing with this one, 1, 2, 3, 4. Yep. Good.
Why do you times into power of? So delta is obvious into there's no minus. So I can understand your thinking, but I'm acceptable more the textbook.
Okay, then in the final exam, you can stick with the textbook approach.
But if you ask me to calculate a delta from portfolio,
Yes?
if I use my delta, but the correct answer is your delta.
Oh, I understand what you're saying. You're saying that
It's
if
different.
If without the exposure, right,
Yeah.
which delta you should use, right? So all of my delta question would come with some exposure to underlying asset. So ultimately, I want you to give me a quantity of underlying assets.
So
I won't just ask you about the number of delta. So for example, the example we go through today, I don't even expect you guys to write the correct sign on the delta when you short put options. I couldn't care less about the sign. As long as you give me whether to long or short in the online. So all I need to know is the quantity of underlying assets and the position of underlying assets. I don't really mind the procedure that will get me those two answers.
So if I use the textbook method,
Yeah. So you would never come across a situation where I only ask you to calculate delta. Yeah.
So I think the delta is always be positive, but it is really depends on the you long and short the asset. Because if you if you hold the call options and of the underlying asset, and then you want to create the delta neutral, means that you need to first understand what the position you hold of your underlying asset. The delta should always be the positive, but the option you hold
but this is not my question.
It could be.
Because in textbook, my delta is the delta contains
She's talking about delta on the futures contract.
containing one futures, but if your delta, I think your delta is like
Okay, so be more specific. You will never come across the question. I only ask you to calculate delta. I always ask you the position and the quantity.
so the final answer is correct.
Yes.
So what's your question?
Because the delta of futures contract
Extra one.
in textbook and in lecture notes is different.
In the textbook, I think it is 1 power to the 1
Okay, so I'll correct my lecture slides. I'll make updates, which the update I'll specify the delta that I said with the power of minus is getting the quantity. Then I'll put additional slides which says that the normal way you're calculating delta is the positive side. Okay? Would that be okay for you?
Okay.
Yeah.
Thank you.
Excuse me. Very quick. Sorry. The questions about the exotic option of the barrier option and I think look back at ancient options. So first is about ancient options. So in the lecture, I cannot quite understand what the means of the price option or the strike option. This means that we do have the different payoff for these two set of option, or this kind of option is there is one option with the different payoff. I don't quite understand this. There are two options.
Yeah. Do you mind if we talk outside?
Yeah.
Let's talk outside because there were people coming in a sec.
I'm so sorry.
Yeah, that's okay.